What's up, guys? Welcome back to the channel. In today's video, I'm going to be comparing two of the most popular ETFs head-to-head, SCHD, which is the Schwab Dividend ETF, and VOO, which is Vanguard's S&P 500 ETF.
Fight!
And the goal is to decide which one is best for long-term investing if we could only pick one. I'll be breaking down everything we need to consider when looking at a fund, from capital appreciation and dividend yield to each fund's top holdings and overall strategy. So if you've been eyeballing either of these two funds, this video is going to help you decide which one to invest in or which one you might want to avoid. See you after the intro. So hey guys, if you're new to the channel, my name's Kyle and I make a video every Monday and sometimes Wednesday about making money, investing, and personal finance. So if you're into that kind of content, consider subscribing to the channel so YouTube knows to recommend more videos like this in the future. So let's start with the methodology that each fund uses to pick the companies that are in each ETF. Broadly speaking, VOO tracks the S&P 500 Index, which is made up of 500 of the largest companies in the US. And to be eligible for this index, a company needs to be US based, needs to have a market cap of at least 11.8 billion, be relatively safe from bankruptcy, and it has to have positive earnings over the last 12 months. And notice with this methodology, there's no mention of dividends at all. And we're actually gonna talk about this a little bit later. SCHD, on the other hand, also tracks an index, but its goal is centered around dividends and income. So to be eligible for this one, a company needs to have paid dividends for a minimum of 10 consecutive years, have a minimum market cap of 500 million, and daily trading volume of at least 2 million. So after that initial screen is performed, the results are then they sort it by dividend yield, and the top half of the stocks are kept and also ranked by yield, 5-year growth rate, and some other things like that. And then once they do that, the top 100 make the index. So to summarize the differences real quick, VOO tracks the market, whereas SCHD focuses more on dividend yield. So how do these compare? Although dividend yield isn't considered in the methodology for the S&P 500 Index, VOO still has companies in it that pay a dividend. Take Apple and Johnson & Johnson, for example. They both pay dividends. It's just that the goal of VOO is not focused around dividend yield. And at the time I'm recording this video, the current dividend yield for VOO is 1.29%, meaning that if you had a $1 million portfolio, you'd earn roughly $12,900 in dividends every single year. And that's not too bad for a fund that tracks basically the overall market. SCHD, on the other hand, has a yield of 2.9%, meaning that that same $1 million portfolio would earn roughly $29,000 in dividends, which is more than twice as much as you'd be earning compared to VOO. So if you're more focused on income, SCHD is going to be the winner. But in order to calculate total return, we still need to factor in capital appreciation. VOO shines in this category, and generally speaking, this is the trade-off you're going to encounter when you're choosing between a dividend yielding fund and something more towards growth. Generally speaking, dividend paying companies are more mature and have less growth prospects. So what they do instead is they just give it to the shareholders, which is great. Think about a company like Amazon, for example. Amazon is growing so fast and investing all of their cash. They don't have anything sitting around. Coca-Cola, on the other hand, it's already so spread out all over the globe that it doesn't really have that much room for growth unless they make new products or maybe acquire other growing companies. And for this reason, because of this trade-off, SCHD, more focused on dividends, it's always gonna lack in growth compared to a fund like VOO that has your Teslas and Amazons and Apples in it. SCHD will eliminate these companies because they either don't pay a dividend or the dividend is just so low that it wouldn't be included because dividend yield is a factor. And so think of something like Apple. That's a huge company, but their dividend is just too small. So to slap some numbers on this one, over the last 10 years, SCHD has grown about 207%, whereas VOO has actually grown 264%, meaning if you invested $10,000 in SCHD, 10 years later, it would have been worth $30,600, and VOO would be worth $36,400, so like $6,000 more dollars over that time period. But real quick, just to mention total returns, VOO in the last 10 years has outperformed SCHD overall, returning 340% to SCHD's 313%. And this combines both the capital appreciation and the dividend yield. So capital appreciation and total return, VOO wins, but SCHD wins when it comes to the yield. And I did want to mention the expense ratio. This is going to be pretty fast just because you want to consider this when you invest in ETFs, and both of these are actually just so cheap. VOO is 0.03% and SCHD is only 0.06%, meaning that for every $10,000 invested per year, you'll pay $3 and $6 respectively. So it's really nothing. Next up, I want to compare the holdings, diversification, and risks of these. So ETFs can be pretty diverse based on many different metrics: market cap, the number of companies in the fund, the sectors that make up where the companies fall into, things like that. VOO, I mean, this is pretty obvious. It holds 500 companies spread out over all different sectors that make up the top 500 companies, compared to SCHD, which only holds 100 companies in it. And it also excludes REITs, which are real estate investment trusts, which is kind of a bummer for me because I really like real estate. REITs typically have a higher dividend yield, so if they were included in SCHD, it would no doubt increase the yield. But like I said, it's not in there. No fund, I guess, is going to be perfect. There's also a concentration risk that you have to take into consideration because there's less funds, there's less companies in SCHD. So the top 10 holdings in VOO make up roughly 28% of the fund, and in SCHD, the top 10 make up 40%. So if any one company in SCHD goes bankrupt, it might sting just a little bit more. But overall, for this section, when it comes to, with over 500 companies in the fund compared to 100 in SCHD, VOO wins as far as diversification and risk. And real quick, by the way, if you're getting any value out of this video, don't forget to hit the like button. It helps me out. It makes making these videos a lot more fun. And are there any other ETFs that you'd like me to take a look at? Let me know in the comments. All right, so we're almost to the point where I'm gonna declare a winner of these two funds. But before I get to that, I need to ask you an important question. Do you plan to ever sell any of your actual investment in order to live your life in retirement? Or are you planning to live only off of the dividends? Let's talk about some numbers real quick. Say that your living expenses in retirement, you're expecting them to be about $50,000. With a $1 million portfolio earning 1.29% like dividend, like we talked about earlier with VOO, you'd earn $12,900 in dividends per year. Remember, your expenses are $50,000, so it's not gonna cover it. The average annual Social Security benefit is $17,000 a year right now. So that brings you to about $30,000. Where are you going to come up with that $20,000 difference? You got some options. You could get a part-time job, you could downsize your living situation, or you could sell some of your stocks. Personally, I never want to sell any of the stocks in my funds because once you start doing that, you start diminishing your portfolio value and the dividends that you're gonna receive ever after. That becomes a stressful game of, I hope I die before I run out of money, and honestly, I don't wanna have to live like that in retirement. One last thing worth mentioning is that time is gonna play a factor in this. You're gonna be most likely accumulating your money over a long period of time. So if you invest in a fund like VOO, you're gonna get to $1 million faster than you would investing in SCHD, where, because of the difference in total return like we talked about earlier. On the flip side, because of higher dividend yield of SCHD, you don't need to accumulate as much money in order to live off of the dividends. Essentially, do you plan on a bigger portfolio and slowly killing the goose in retirement? Or is your goal to raise maybe a smaller goose that pays you enough to live off of dividends forever without actually touching your portfolio value? I mean, this doesn't necessarily have to be an either or decision. For example, if you end up with a $5 million portfolio made up entirely of VOO, at 1.29%, that comes out to $64,500 in retirement, which is above the $50,000 that you needed that we just talked about. Time to declare a winner. And before I do that, I want to mention, remember, I'm not a financial advisor, so don't take this as investment advice. Do your own research before investing your hard-earned money. But if I had to pick one, I'm going with SCHD, and here's why. 3 reasons. First, the total return doesn't keep up with VOO. But in my opinion, it doesn't lag that bad considering the dividend yield is more than double what VOO is. That combined with it's motivating to receive the dividends. And the larger they are, the more I want to keep investing, which I might not do as regularly if I invested in a lower yielding fund. Lastly, cash flow reduces stress. Even if I'm not having the best month with like wholesaling or drop shipping businesses, seeing that passive dividend income coming in allows me to sleep better at night. I mean, you might think that that's kind of ridiculous. The last two reasons were sort of like emotionally based, but make no mistake, investing is an emotional thing. You know, it can be hard to stay the course during price swings and market uncertainty. So understanding yourself and how you're going to react to market events should play a role in your decision when you pick a fund. So full disclosure, I do own SCHD and I do not own any VOO. So let me I'll hop into my computer real quick and I'll show you my Robinhood account. All right, so here we are in Robinhood Schwab US Dividend Equity ETF. You can see that right now the market value that I have on it is $37,808, and it makes up 85% of the portfolio. If you watched my video last week, you know that I actually want this fund to be 70% of the portfolio. So I'm looking to buy Stag and O Realty to add to the portfolio and kind of balance this thing out a little bit. Like I mentioned, I really like real estate. But currently, that's where I'm at. If you're still here, you're awesome, and thanks for watching. If you'd like to support the channel and grab my dividend track sheet, you can find me over on Patreon. I give my trade alerts whenever I buy or sell anything. You know, you also get access to the Discord if you like Discord. So links for all that is down in the description. You can also grab free stocks, Robinhood, Webull, all that, like on anyone else's video. But that's it for this one. I will see you later.